Greetings and welcome back to the podcast. This episode, we are joined by Mr. Jordan Zinberg, President and CEO of Bedford Park Capital, an independent investment firm located in Toronto, Ontario, Canada. Mr. Zinberg has over 15 years of investment industry experience, including portfolio management and trading, and has served as a director for both private and public companies. Prior to founding Bedford Park Capital, Mr. Zinberg was a managing director and portfolio manager at a Toronto investment management firm. Mr. Zinberg holds an MBA from the Schulich School of Business and holds the Chartered Investment Manager designation and is a fellow of the Canadian Securities Institute. Among other things, we discuss bottom-up stock picking, Alberta entrepreneurialism, and why Canadian small-cap stocks present opportunity. Enjoy! This podcast episode is sponsored by Embarrass. Embarrass is the world's largest energy-dedicated software-as-a-service company committed to helping customers close the gap between data and value creation. Embarrass has been supporting the Canadian energy industry for over 30 years. Visit Embarrass.com for more details. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This episode is sponsored by Contango Commodity Marketing. Are you keen to learn more about the Western Canadian crude oil market? Contango Marketing is hosting a 2-day introductory course that provides comprehensive learning on logistical and commercial practices, practical insights into industry trends, and current market fundamentals. Spots are limited, so register now at contangomarketing.ca. This episode is brought to you by Upgrade Labs. Upgrade Labs offers a comprehensive range of cutting-edge performance and recovery services that have been proven to optimize your health in minutes, not hours. Whether it's accelerating muscle mass and bone density or addressing injury and inflammation, start your experience by booking a free cell health analysis at upgradelabs.com/Calgary. Good afternoon, Mr. Jordan Zinberg. Thank you very much for doing this. I appreciate your time.
My pleasure.
For the listener, you are the CEO of Bedford Park Capital. But
yes, Bedford Park Capital.
What is Bedford Park Capital?
Bedford Park Capital is a Toronto-based investment firm that I founded with a partner in 2018. And we invest primarily in public securities with a focus on Canadian small and mid-cap growth stocks. However, we are active in a number of other areas as well.
Why did you start Bedford Park Capital?
I started in the investment business when I was 24. And by my late 20s, I knew I wanted to own my own investment firm at some point. And I was working towards that goal. And by the time I was in my late 30s, I knew it was now or never. So in 2018, I took the leap and haven't looked back.
If you go back to the beginning, how did you get into investing?
I think the first exposure I had, not to investing, but just to market dynamics, was through trading baseball cards. When I was 12 or 13 years old, I got really interested in baseball cards, and it was a bit of a mania at the time. And watching how baseball cards traded and how the pricing changed and the spreads between what people were willing to buy versus sell, I think gave me that first introduction to how a market actually works. And a few years later, I received some shares of stock from an aunt and uncle of mine. And I started reading the paper so that I could look up the prices of the stock that I had. And through that process, got very interested in investing. And by the time I was 18, I was hooked and started trading stocks and studied business in school and pursued a career on Bay Street after that.
Do you have an investing style / influence, maybe value, growth, momentum, quantitative, quality?
My style blends almost all of those elements together, some more than others. I would say, think about Warren Buffett combined with Peter Lynch and a touch of William O'Neill, and then put a little bit of my own flavor on top as well. So I hate to put myself in a box. If I had to, I would say my approach is largely growth at a reasonable price. And actually, let me add on to that, profitable growth at a reasonable price.
What makes Bedford Park Capital different than other investment funds in the sector?
I think it really comes down to three things. I think it's the part of the market that we invest in, the type of companies we look for, and then our experience and contact networks. Let me expand on each of those in a bit more detail. So the part of the market we invest in, we invest largely in Canadian small and mid-cap growth stocks. And obviously there are other investors that focus on that portion of the market, but more specifically, we focus on profitable growth stocks. And unlike a lot of other Canadian small mid-cap managers, we don't invest in resource stocks. So if you look at what we're actually doing, we're investing in a very small portion of the market, non-resource. And then in terms of the types of companies that we look for, we're very specific on size and a number of other financial characteristics that we require before we'll even start doing work on companies. So I think the type of company we look for is different than a lot of others. And then lastly, in terms of experience and network, I've been investing in this part of the market for almost my whole career. And I think the relationships that I have give us a key advantage because our relationships with brokers, individual companies, executives, board members, bankers, we're really able to draw on a vast network that helps us with everything from seeing ideas early to how we buy and sell stocks. And I think for somebody who hasn't had that same experience and time in this part of the market, it's a real advantage for us. It gives us a bit of an edge over others. And I think the same thing would exist if I tried to go do this in another market. Somebody who was based in that market and had a lot of experience in that market would clearly have an advantage over me. So that's the reason we only invest in Canada. It gives us, to use a sports analogy, a bit of a home court advantage.
Do you run a concentrated portfolio or do you diversify? How many names are you investing in?
The fund typically has about 20 to 25 positions. So we're fairly concentrated. But to expand on that further, I think it's not 25 positions at 4% each. And typically, the way that our fund would look is we'd have 10 larger positions that would usually make up about 70% of our capital. And then we'd have 10 to 15 smaller positions underneath. And using another sports analogy, think of it as our farm team or a rookie team. And those are smaller positions, newer names that we're looking at, things we're getting up to speed on and studying and deciding where our conviction level really lies. So according to what you'd see from most managers, we use a fairly concentrated approach.
Last 2 years, more or less, the S&P 500 has been doing very well. Knowing that, what's your value prop to investors who have a pretty good option in the index, especially of late?
I think the S&P 500 is a great core investment for most investors, and we're not trying to compete with that at all. Our fund is not somewhere where investors would look to make a large allocation within their portfolio. So I think the S&P 500 is a great diversified basket of mature, fantastic companies, and I wouldn't tell anyone not to own the S&P 500. Where we're positioned is as part of somebody's Canadian equity exposure, and more specifically, somebody who wants exposure to Canadian small and mid-cap growth stocks. So typically an investor would look to invest, say, 5 to 15% of their portfolio in our fund, as opposed to what you would use for a core position like an S&P 500 or an S&P TSX. And the way that our fund is positioned is to help hopefully improve the overall returns of the portfolio. So in years that the market does well, we've typically done quite a bit better, and it's helped to bolster overall returns for our investors.
On that note, I believe the fund is up approximately 50% year to date.
53% through the end of August, yes.
So things are going well.
It's been a fantastic year so far. The year's not over yet. I'm sitting here in mid-September, and I've been doing this long enough to know that until December 31st hits, you can't really think too much about your year. So we're just continuing to keep our heads down and execute on our strategy. And quite frankly, I'm still excited, despite the move that we've seen in a lot of our stocks in our portfolio. I was commenting at dinner with one of our investors last night, and he said, the fund is up so much. Are you worried about valuations? And I said, no, actually, when you look across our portfolio, we've got a basket of growth stocks here that's still trading largely on a single digit PE multiple. It's maybe a little bit higher than it would have been 6 or 12 months ago, But we are still continuing to own and find a lot of fantastic growth companies that are trading on 7 and 8 and 9 times forward earnings.
A lot of the best investments are long term, but unfortunately, there's a lot of eyes on quarter over quarter performance and even annual performance. How do you balance long term growth with the stress or short termism in investing like that?
I think you have to be watching both. I mean, short term, obviously, we're staying on top of our companies every quarter. We're reading all the information that comes out each quarter, and we're speaking to management teams and understanding why a particular quarter might have been good or bad. But for the companies that we tend to hold, we tend to hold them for years. There's a few names in our portfolio that we've had since day one, 6 years ago now. So we don't tend to buy companies and go to sleep. We'll buy them and manage our position and trade around our core positions. But in many cases, we're not looking at an individual quarter. We're not fast money players where we're betting that a quarter might be better or worse than expectations, hoping to make a quick 5% on a quarter. That's not at all what we do. There's certainly investors who do that and who are good at it. And there's room perhaps for that, but that's very far removed from our strategy. We're looking to find companies that we think can grow at 20, 25, 30% for a number of years. And we're looking to get into those companies early on before other investors are noticing. And then we try to get close to the companies, get smart on the overall story. And if the stock performs and the business is executing, we're hopefully adding to that position and owning that stock for a long period of time. So we're trying to get in early and then capitalize as others discover what we've already found. And typically then you see earnings rise, you see valuation multiples expand, and that's when you can make significant returns on stocks in your portfolio.
Do macro factors impact your portfolio like interest rates? Do you spend much time on that? And if so, how do you view interest rates in the next few months, going up or down? What are your thoughts on that?
I spend very little time thinking about macro. I think macro investing is a completely different skill set than what we do. I think macro investing is very difficult. And when you look at the best long-term track records in investing, there are a few great macro investors on that list, but most of the investors on that list are largely bottom-up stock pickers. And I think we fall into that same type of strategy because even if I could predict the future course of interest rates, even if you told me the next move was up or down, it really wouldn't change very much what we're doing on a day-to-day basis in our work or in our portfolio. So obviously we're paying attention to macro trends, and you have to have some type of feel or view as to where you might be in a cycle, which might cause you to be a little more aggressive or a little more conservative in terms of how you size your portfolio. But overall, I would say less than 5% of my time is spent thinking about macro factors like interest rates.
So how do you spend your time? For example, some investors spend their days looking through annual reports. Others spend their days reading the news. Others meeting management. Do you do a little bit of everything, or how do you approach your investment strategy in your day?
It really depends on what day or month we might be in. So during earnings season for that 3 or 4 week period, obviously very busy going through results as they come out, going through and figuring out how the results compared to what we were expecting, reading what analysts who may cover the stocks are saying, speaking to the companies themselves and forming a view on the quarter and looking for any clues on what we might see from the companies going forward. So outside of earnings season, it's largely maintenance on our existing positions, looking at new ideas all the time, maintaining our internal database that we have of about 250 names, looking to constantly upgrade, add new names and recycle names within that list. And then there's the non-portfolio management functions as well, everything from trading to talking to existing investors and meeting with new investors, overall running the business itself. So, every day could be different, but I enjoy every aspect of it and get very excited every morning when I wake up to get to work. So we just come in every day and we have fun and try to make money for our investors and then go home.
As an active fund manager, I suppose you would not subscribe to the efficient market theory. Knowing that, where do you look for mispriced opportunities? How do you find things that other people haven't seen?
Well, if you think about what I've described as our process, looking at companies that are growing at very high rates, you might sit back and say, okay, well, everybody wants to buy companies that are growing at very high rates. And usually that results in these types of companies having relatively high valuations. So what I'm trying to do is sift through all those high growth, profitable businesses and figure out which ones, for whatever reason, don't have what I consider to be a fair or expensive valuation. I'm looking for ones that, well, I don't expect to find those companies at a distressed multiple and extremely cheap. I want to find them on what I call a reasonable valuation, and I'll explain what that means in a minute. But usually when we find it, the reasons are typically one of a few. It's either a small company, and when a company's too small, larger pools of capital just simply can't invest. Large funds and ETFs just can't invest in the name. Even if they are aware of the company and like the company, they can't buy it. So that's reason number one, is the company is just too small. The second thing is a lot of the companies can be underfollowed. And in order to understand why companies are underfollowed, you need to understand the way the industry is structured. So when you have companies that require a lot of capital, they need investment banks to raise that capital, and they're very profitable customers for investment banks. And as a result, investment banks will write research and support those companies in any way that they can. When you have a company that's largely self-financing because they're very profitable, there's not a lot of incentive for investment banks to cover the company, because there's not going to be a likelihood that they're going to be able to go out and have an opportunity to raise an additional equity for that company. The companies are self-financing. They don't need the equity. So a lot of times what's surprising to people outside the industry is that some of the best companies actually receive the least amount of attention from Bay Street. So there's another opportunity there, just in terms of companies that are under the radar, not because they're bad companies. It's actually the opposite. It's because they're such good companies. Another reason can relate to liquidity. So a company can have a decent size, but let's say the founder owns a huge chunk of the company and there's a few other institutions that have big stakes, and it's just not a very liquid stock. So there are some funds and ETFs and other pools of capital that require certain amounts of liquidity. So you can have a really good company that's just not overly liquid, and because of that, it will trade at a bit of a discount. We're happy to come in, own stock, and own that stock if the company's performing, until that situation changes, either because the company gets bigger or they do a financing, or the liquidity profile of the business changes. So those are some of the bigger reasons. It can also be other things, such as the company just being in an industry that's out of favor or not very well liked. I'll give you an example. We've done very well in Canada with the Canadian alternative lenders, so the non-bank lenders. And that's an area that a lot of investors tend to shy away from. They don't understand the space very well, or they're so full with all their other financials, like their banks and insurance companies, that they don't get down to the specialty lenders. So sometimes it can just be the sector that the company is operating in, where we're going to come in and take a bit of a different view and ignore the fact that the sector is a bit out of favor. So there's a list of probably 3 or 4 or 5 things, and there's probably about 8 or 10 things, but there's a number of reasons why you're able to find outstanding businesses at lower multiples. And particularly with Canadian small caps, there's just not a lot of eyeballs in the space. A lot of institutional capital has left Canadian small caps, which is creating a ton of opportunity for those like me who remain.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast is brought to you by Energy United. Energy United is an organization with a mission to promote practical energy policy across Canada. Energy United is building a community of Canadians that are passionate about Canada's natural gas and oil industry and are willing to take action. Energy United is driving change on issues that matter, all the way from the carbon tax to the emissions cap. Join Energy United to make a difference at energyunited.ca. I guess the question is, why has capital left small and mid-cap Canadian equities?
I think there's a number of reasons. A lot of the small and mid-cap Canadian equities that tended to garner attention in the past were resource stocks. And part of the reason for that is, outside of Canada, if you think about non-domestic investors, they're not coming to Canada to buy tech stocks or consumer stocks. They don't need to come here, or big pharma. There's a bunch of sectors we actually are not very well represented in. But what Canada is known for outside of our own country is our resource stocks. And let's face it, the last several years haven't been kind to resources, with some spurts in the middle, obviously. So I think that's one of the main reasons, is that a lot of the non-domestic investment capital is not really focused on our market right now. And then even within our market, we've seen consolidation amongst financial firms that are involved in the space. We've seen overall size of firms shrinking as the industry's changed for a whole bunch of reasons. I think there's a number of factors, but the fact remains that I think there are a way smaller number of players in this space than there were even 10 or 20 years ago.
Like we mentioned, the S&P 500 is a pretty good option for a lot of investors. Sometimes portfolio managers are forced to follow the S&P 500. Has that created opportunities for you as well, with larger investors who are forced to index or partially index, leaving small cap names for people like yourself?
Yes. And again, the S&P 500 would be for US equities. We're focused exclusively on Canada. So even if you said the same thing about the TSX, yes, the majority of eyeballs on Canadian equities would be focused on the biggest 50 or 100 companies in Canada. These are the names that everybody would recognize, the Royal Banks, etc. So when most of the eyeballs are on those names, and there's very little attention being paid in other corners of the market, like the corner of the market where we're active, it absolutely does create opportunity for us. And quite frankly, to your point, I don't think investors need to hire somebody like me to go buy blue chip stocks. I think any investor who's willing to spend a little bit of time can put together a portfolio where they buy one or two banks and maybe an insurance stock and a couple energy names, and pick a couple consumer names and maybe a telco. And I mean, you've pretty much got the Canadian market covered, probably within somewhere between 8 and 10 names. But what I think a lot of investors can benefit from is exposure outside that core, with some of their portfolio allocated to different strategies, like ours, for example, or other specialized strategies where it's going to give them some overall diversification in their portfolio. It's going to give them exposure to names, companies that they probably wouldn't find on their own, or even if they did find on their own, wouldn't be able to diligence as well as somebody like us. So just blending in a few different other tactics into the portfolio can really help to smooth volatility. And, there are going to be certain months where one manager or strategy or market is going to be working differently than another. So you're probably not going to get too hurt by going out and buying the S&P 500 or the TSX, but by virtue of the fact that you're indexing, you're giving yourself 0% chance to outperform the market. So for those who are actually interested in trying to outperform the market and improve their overall portfolio returns, they have to do something different than the index. And the way to do that is to add some specialized elements to your portfolio to help bolster your overall return.
One concern from investors when picking out of favor names or small mid-cap companies is that at times they can be a value trap. How do you avoid that? And in your experience, what's the best way to catalyze that increase in stock price?
So when you say value trap, I'm assuming you mean a stock that you find that you think is cheap and it just stays cheap. Is that what we're talking about here? Okay, just to define what we're saying. So when I'm looking at an idea or somebody's pitching me an idea, if all the idea has going for it is that it's cheap, it's generally not something I'm interested in. As you correctly pointed out, stocks can stay cheap for a long time, and they can even get cheaper if the business is having issues. So I think the best way to avoid it is to make sure you're not just looking at names based on valuation. And furthermore, one of the best ways to ensure that doesn't happen is by buying stocks that are steadily growing their earnings. And what I mean by that is if the earnings are growing significantly, even if the multiple is not moving, the stock will still go higher. So let's say you have a company that's making $1 a share and it trades on 10 times earnings. So it'll be a $10 stock. Well, if they're growing those earnings by 20%, the next year the earnings are going to be $1.20. And even if the multiple doesn't change, you're going to have a $12 stock, right? Because you've just held the multiple constant, but the earnings have gone up 20% and the stock price has gone up 20%. In a company that's not growing, so let's look at that same example. Instead of $1, the next year they make 80 cents. Well, now the multiple at 10 times is going to be $8. But if the multiple contracts to say 6 times, now it's $6. And you don't have that growth in earnings on the other side. So going back to our original example, if the company is growing its earnings from $1 to $1.20, let's say the multiple even contracts a little bit. It goes from 10 times to say 9 times. You're really not going to lose very much money because the growth in the earnings is offsetting the multiple compression. So I guess to make a long story short, don't just look for cheap stocks, and use stocks that are companies that are growing their earnings at a high rate to help give you some protection from multiple compression.
Back in the old days after the Depression, one strategy that you could pursue is the net strategy. I think it was Ben Graham, where you'd buy companies, subtract the liabilities from the current net assets, and end up with a liquidation value. Have you seen any of those in the market lately, or are they kind of a relic of the past? Does it happen anymore?
It still does happen. I've run screens like that before, and I've seen screens that others have run like that before. You largely end up with companies that are in some type of distress. Typically, there's usually a reason why that's happening. So it's an interesting strategy, but it's really more of a deep value strategy. And generally, the types of companies that I'm looking for will never trade. You'll never find a company like what I'm looking for on those screens, because the earnings are just growing too fast.
You've had a number of companies in Alberta that you've been interested in lately, one of which is Main Street Equity. How come you invested in Main Street Equity, and what attracted you to the company?
I met with Main Street Equity probably first, maybe 4 or even 5 years ago now. And as I listened to the story of the business, and I know you've had the CEO, Bob Dylan, on your podcast before, so I won't get too deep into the story. But as I heard the story of the business and realized what he had been able to accomplish, it's actually, in my mind, one of the best compounders in Canada. And it isn't really well known amongst investors, even though it's almost a $2 billion company. So what Bob's been able to accomplish has been spectacular. But I think the most interesting part about this story to me is that he's been able to grow from 200 apartments to 18,000 apartments without raising any equity. That's the key to this whole story. His share count is pretty much the same as it was 22 or 23 years ago. So there's lots of other real estate businesses in Canada that have grown, but they've raised a lot of capital along the way. Bob has been able to just use cash flow and debt, and he's done a very good job in terms of securing low cost financing for the business. And he's been able to grow his portfolio organically over a number of years. And I think, there's still a ton of upside in Main Street. And I did actually devote one of our quarterly investor letters to Main Street a while back. And what I said in the letter was that Main Street is the name in our portfolio that I lose the least amount of sleep over. And I still believe that to be true today. These are entry-level apartments. There's a huge demand for housing in Canada. There's a huge demand for these types of apartments. And Main Street continues to buy these buildings at very good prices. They go in and use their process that they've been using for many years to renovate, refinance, and just continue to buy more properties. So I absolutely love the business. Not only that, I think there's some additional blue sky in the company that you're going to see start to evolve over the next couple of years. So we're still very constructive on Main Street, and I think it'll be in our portfolio for a long period of time.
Bob Dylan also has a lot of skin in the game and did this podcast as well, like you mentioned.
And we love founder-led companies. And actually, it's interesting you brought up the point about us investing in Alberta-based businesses, because I find a lot of the Alberta-based businesses I tend to be attracted to are founder-led situations where the CEO and the rest of the management team own very large stakes in the companies. And I find our Alberta-based CEOs have a great entrepreneurial spirit that I don't always see with CEOs from other provinces. So, I think there's a number of companies that we already own that are Alberta-based, and we're constantly looking at new ones as well.
When did you notice the entrepreneurial streak in Alberta?
Probably, I would say about 10 or 15 years ago, when I started coming to Calgary a little bit more regularly to meet with companies. I just noticed a bit of a different feel in talking to the CEOs. And it was just an idea that kind of has stuck in my head over the years. And I've continued to see it up until today.
So it's true. Do you notice that coming from the East, that there is a bit of that in Alberta?
Absolutely.
What else do you see in Alberta that attracts you? I think you've got a couple other names.
Yes, absolutely. One of our biggest winners the last couple of years has been a company called Source Energy Services. Are you familiar with it?
Yep.
So Source Energy, for those who aren't familiar, is probably the largest frac sand provider in Western Canada, with about 40 to 50% market share. They bring the sand by rail up from the US into Alberta and Northeast BC and sell sand to some of Canada's largest energy companies. And I first bought Source a couple of years ago at $1.60 a share. and it's been a fantastic winner for our fund. The stock's come off a little bit lately, closed today just under $12, but it's been much higher, and I think it'll continue to go much higher. Source is positioned extremely well right now. You're probably going to see them refinance their debt in the next quarter or two. They just announced a joint venture with Trican that I'm quite excited about. And I think Source is still one of our top ideas, despite the move in the stock, one of our top ideas in our portfolio. And they're based right in Calgary.
Trican did the podcast actually on a side note. So yeah, familiar with the story. Any other opportunities you're seeing in Alberta?
There's quite a few. I mean, I'll mention maybe just one more. There's a small little company called Enterprise Group. It's an oilfield services company that we invested in last year. The stock's done extremely well since we invested. It's a traditional oilfield services company, but they have a very fast growing power division that's really driven the margins of the overall business higher. And I think is going to continue to grow at an extremely fast pace. So Enterprise, the ticker is E, would be another one in Alberta that we're quite excited about.
Today is Tuesday, September 10th, 2024. What advice would you have to retail investors out there who are looking to add to their portfolios?
I think, as you alluded to earlier, it's very cheap and easy for investors to get index exposure. So that's something they can definitely handle on their own. If they have the desire to get into picking individual stocks, I would say you have to make sure that you not only have the interest to do this, you have to have the time to do this as well, because investing is simple, but it's not easy. And if you're going to try to outperform, let's say someone like myself, who's spending 55 or 60 hours a week focused on doing this, if you're going to try to outperform, you better spend a lot of time and you better be very interested, because otherwise it's going to be very difficult for you to outperform a professional manager. I think one of the problems is that the industry's made it so easy for people to trade and buy stocks on their phone. They've almost turned it into a video game. And what I always say is, just because people can buy stocks on their phone doesn't mean they should. And unfortunately, I think the industry has convinced everybody that they can just run their own money, and sometimes it can have disastrous consequences. So I would say, if you're unsure or you don't have the natural interest or the time to do this, definitely speak to a professional in the business and get some help.
Are there any books, podcasts, or resources that you might share with someone listening to help learn about investing?
I think looking back, I've read numerous investment books. They've all been helpful in one way or another. I think you just have to continue to explore different ideas, whether that be through books or podcasts or whatever way that you like to learn. And I think a big part of it is, going back to advice for investors, a big part of it is just figuring out who you are as an investor and figuring out what style makes sense to you. And that might change over time. I think people oftentimes start out as value investors and then morph into growth or other types of investors, like you saw even with Warren Buffett. I think naturally everybody can identify with the idea that you can try to buy a dollar for 50 cents, and it sounds great if you can actually do it. But over time, you realize that investing is not actually that simple. So I think a big part of it is just understanding who you are as an investor, what approach works for you, what you're going to be able to stick to when the market gets volatile. And that's a huge part of the journey, is just figuring that out over time and figuring out, what works for me might not work for you. Those can be two different things, but I would say read as much as you can and just follow where your natural interest lies within investing.
Well, I think that's a great place to leave the conversation. If somebody wanted to learn more about Bedford Park Capital, where might they find you? Online?
Sure. Our website is bedfordparkcapital.com. And if anybody is interested, they can send us an email to info@bedfordparkcapital.com.
Awesome. Well, unless there's anything else you want to cover, I think that's it.
That's great. Thank you very much for having me on. I really appreciate it.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca, where more episodes are yet to come. You can also subscribe to the podcast, where your token of support is much appreciated. Until next time, happy coffee drinking.